Everyone is talking about NVIDIA, about OpenAI, about massive language models. But what happens when the demand for artificial intelligence outstrips the planet's capacity to power its servers? We are approaching an energy crisis driven by data centers. That's where Applied Digital Corporation steps in. A company that was mining crypto in 2021 is now building the infrastructure for the AI revolution and has secured $11 billion in contracts. Applied Digital went from near obscurity to becoming one of the hottest stocks in the market, up over 800% in just months. They're building massive data centers in the middle of North Dakota, powered by cutting-edge liquid cooling technology, and hyperscalers like CoreWeave are betting billions on their infrastructure. A single campus whose first phase stretches to 400 megawatts, and a second site already staked out for 280 megawatts on the way to 1 gigawatt. Welcome back to the Capital Navigator, the channel where we dive deep into the strategies, business models, and financial realities of the world's most influential companies and the investment opportunities they present. Today, we are diving into the data center sector, but with a twist. We'll be talking about Applied Digital Corporation, a company that has executed a masterful strategic transformation to become a key infrastructure provider for high-performance computing, HPC, the engine of AI. But here's the catch. The company is burning through nearly $800 million in free cash flow, drowning in debt, and betting everything on execution. Is this the next data center giant riding the AI boom, or a house of cards waiting to collapse? This is the story of Applied Digital Corporation. The origins, from crypto to AI infrastructure. Applied Digital traces its corporate incorporation back to Nevada, May 2001. But the company you're looking at today was essentially rebooted in 2020 by Wes Cummins. Initially, the company, then known as Applied Blockchain Inc., focused on cryptocurrency mining hosting. The prohibition of cryptocurrency mining in China in June 2021 became a pivotal opportunity. Applied pivoted toward building large data centers in the US to host displaced miners. In less than 24 months from founding, the company brought nearly 500 megawatts of data center capacity online, oriented toward crypto mining clients. The capital market step came in April 2022 with a NASDAQ IPO. By November 14, 2022, the company rebranded to Applied Digital Corporation, explicitly signaling a broader focus beyond blockchain, high-performance computing, and AI infrastructure. It carved the business into three lines: AI cloud services, high-performance computing data center hosting, and cryptocurrency data center hosting. By late 2023, Applied started building a 369,000 square foot facility purpose-built for HPC and AI, recognizing that AI workloads aren't just big, they're power-hungry. That site, Ellendale, North Dakota, would become Polaris Forge 1, the flagship campus. For 2025 and the start of 2026 were marked by massive deals and expansion acceleration, positioning Applied Digital firmly in the AI infrastructure niche, signing a deal with CoreWeave. In August 2025, APLD announced the start of construction on its second campus, Polaris Forge 2, near Harwood, North Dakota, a $3 billion 280-megawatt project, scalable to 1 gigawatt, with first capacity expected in 2026 and total completion in early 2027. So this is a company that has completely transformed itself in just a few years, from crypto mining hosting to becoming a major player in AI data center infrastructure with billions in contracted revenues. The data center market is experiencing an AI supercycle that exceeds historical demand from traditional cloud computing. Demand for accelerated computing for large language models and AI workloads is skyrocketing. The two primary limitations defining competition in the sector are access to energy and supply chain management. Transformers, generators, switchgear, thermal gear, lead times stretched across the sector and prices moved. Applied Digital has adopted a reverse approach to mitigate this. First, secure adequate energy availability for development. Then, verify fiber connectivity. Unlike the traditional approach of finding a location first and then requesting power. Advanced liquid cooling, direct-to-chip, is an essential technological trend. The power densities required by the latest AI processors make air-cooled designs inefficient or unfeasible. The company's Polaris Forge infrastructure was designed with this technology to maintain high efficiency and an optimized power usage effectiveness factor. The business model: build, lease, repeat. Applied defines itself as a designer, builder, and operator of next-gen data centers. The revenue model clusters around multi-year leases rather than short-term hosting. The business model focuses on three segments, though it has recently simplified to two primary ones: high-performing computing, hosting, This is the growth engine and primary strategic focus of the company. Applied designs, builds, and operates high-performance, high-density data centers optimized for AI and high-performance computing, HPC applications. They provide specialized infrastructure for energy-intensive and low-latency workloads, such as GPU clusters. The revenue is based on long-term lease contracts, seeking agreements of approximately 10 to 15 years with hyperscalers or large investment-grade clients. Data center hosting business. This was the original segment and remains an operational part. Offer energized space and electricity to clients who install their own hardware, predominantly for cryptocurrency mining. Cloud services business. This business, operated through Psi Computing, rents GPU clusters directly to AI customers. But the company opted to classify the segment as held for sale and discontinue operations. Two reasons. Large AI tenants sometimes viewed it as a competitor, and simplification aligns the company for potential REIT pathways. Put simply, the core plan is to be the landlord and operator for the AI era, not a public cloud. That's why the contract structure matters so much. In June 2025, the company signed a transformational 15-year lease agreements with CoreWeave for 250 megawatts of IT load at the Polaris Forge 1 campus. Then in August 2025, CoreWeave exercised its option for an additional 150 megawatts. The leases now cover the total 400 megawatts capacity at Polaris Forge 1. The total contractual value of these CoreWeave agreements reached approximately $11 billion in anticipated 15-year lease revenues. Let me repeat that. $11 billion in contracted revenue from a single client. That single customer set transforms the company's visibility. Instead of just a pipeline, Applied has long-dated contracted cash flows it can use to raise project capital and sequence construction. The numbers. Growth with red ink. Applied Digital's financial behavior over the last 3 fiscal years, 2023 to 2025, and the first quarters of the current fiscal year, 2026, has been dominated by its strategic transformation, hypergrowth, and extremely high capital investment, resulting in strong revenue growth but significant net losses and negative free cash flow. Revenue climbed from $55 million in 2023 to $165 million in 2024, then eased to $144 million in 2025. Still a 6% year-over-year growth rate across the period, but bumpy as the company reoriented the mix and prepped the AI campuses. Losses widened dramatically, $45 million in 2023 to $231 million in 2025. Applied's capital structure has experienced a dramatic increase in leverage over the last 3 years, reflecting its intensive capital investment to build infrastructure. Long-term debt went from $33 million in 2023 to $677 million in 2025. That's a 20 times increase in debt in just 2 years. The key metric, remaining performance obligation. Given the lack of meaning in traditional multiples, the key metric for Applied's valuation is its RPO. The company has a contractual RPO of $11 billion with its anchor client CoreWeave over a 15-year period. This RPO provides long-term revenue visibility and is the primary justification for the valuation premium the market applies to APLD, despite its negative cash flows. Investors have been willing to fund that gap because the contracted revenue is large and long-dated. But the stock doesn't trade like a sleepy REIT. It trades like a high-beta AI infrastructure proxy. Through 2025, shares reached approximately $37 in October, more than a 700% gain since May 2025. Catalysts included the CoreWeave expansion to 400 megawatts and Q1 2026 results that beat consensus with revenues of $64 million, an 84% year-over-year increase, and better than expected adjusted loss per share drove the stock up 27% post-report. Valuation has reflected that excitement. In 2025, the stock traded around 34 times EV sales versus a peer average near 3.5 times, a classic AI premium. Bulls will argue the premium prices in visibility plus speed. Bears will note that visibility is not cash flow, and that funding risk sits directly across from the RPO. NVIDIA's $160 million investment in September 2024 served as ecosystem validation and strengthened positive investor sentiment. The challenges. Where this can break. Applied Digital has faced a series of significant challenges throughout its rapid evolution, especially during its transition from crypto hosting provider to HPC and AI infrastructure developer. Customer concentration risk. Dependence on a limited number of large clients represents a fundamental risk for the company. Losing or materially changing relationships with major customers is a key vulnerability. A concentrated customer base heightens exposure to those clients' financial health. The risk is aggravated because Applied's model is based on leasing large capacity blocks, resulting in high customer concentration, financial pressure, and capital needs. The hypergrowth nature of Applied Digital has generated intense pressure on its balance sheet and internal control systems. The company is in an early stage of development and has limited revenue sources. There's a risk that the company cannot access sufficient additional capital to grow. This is a levered, negative free cash flow story during build-out. The debt level can restrict operations and the ability to pursue new business opportunities. If Applied raises additional equity financing, existing shareholders could experience significant dilution of their ownership interests. Execution risk on capital projects. Applied's success depends on its ability to build new hosting facilities on time and with the appropriate contractual efficiencies and margins. Construction of large-scale projects, like the Polaris Forge 1 campus, HPC Ellendale facility, carries risks associated with construction delays, budget overruns, and increases in raw material or construction material prices. Market and competitive risks. The AI data center market is becoming increasingly competitive, with established players like Equinix, Digital Realty, and tech giants building their own infrastructure. If the AI boom slows or if major clients reduce their infrastructure spending, Applied's growth trajectory could be severely impacted. Applied Digital is trying to industrialize the AI data center. This is a company that has executed one of the most dramatic business pivots in recent memory. From crypto mining hosting in 2021 to becoming a major player in AI data center infrastructure with $11 billion in contracted revenues by 2025. They've secured transformational contracts with CoreWeave. They're building massive gigawatt-scale campuses with cutting-edge liquid cooling technology, and they've attracted investment from NVIDIA. The stock has exploded over 700% in months, and analysts are projecting massive future growth. But, and this is critical, the execution risk is enormous. They've increased debt and burned cash. They need to build massive data centers on time and on budget or face penalty clauses. And they're doing all of this in an increasingly competitive market where tech giants are building their own infrastructure. For investors, Applied Digital Corporation is an extremely high-risk, high-reward play on the AI infrastructure boom. If they execute, if they build Polaris Forge 1 and 2 on schedule, if CoreWeave remains financially healthy and honors the contract, if they can secure additional clients to diversify, this could be a multi-bagger from current levels. But if they stumble on execution, if construction delays pile up, if CoreWeave hits financial trouble, or if the AI spending boom slows down, this stock could collapse quickly. The contracts are signed, the technology is proven, but the debt is real too. The negative cash flow is real. The concentration risk is real. So what do you think? Is Applied Digital the next great AI infrastructure play, or is this valuation getting ahead of reality? Are you bullish or bearish on Applied Digital Corporation? Drop your thoughts in the comments below. I want to hear your perspective. And if you found this deep dive valuable, smash that like button and subscribe to the Capital Navigator. We break down high-growth companies like this every week, giving you the analysis you need to navigate the most exciting opportunities and risks in today's market. Thanks for watching, and see you in the next video.